Thank you for tuning in to our Retirement Education Center YouTube channel, where on this channel, we believe in providing you unbiased advice to help you maximize all of your retirement income. Now, on our channel, we do not believe in providing you any silver bullet strategies or promoting any type of one product. But what we do believe in are holistic concepts to help you retire with confidence. Now, the subject that we're going to be discussing today is, should you be dollar cost averaging or trying to lump sum investing, or better known as buying the dip, in a down market? Now, if you're like most people today, you're probably concerned about this particular situation as the market is actually in bear territory. So you're definitely going to want to stay locked in today, as we are going to talk about the differences and the advantages of dollar cost averaging versus lump sum investing. Hi, my name is Carson Graves, President and CEO of the Retirement Education Center.
And my name is Andrea Graves, Director of Operations at the Retirement Education Center. And we want to thank you for tuning in to our Retirement Education Concepts videos. These videos were created to help to make the difficult and confusing retirement process simple.
Absolutely, Andrea, because with so many retirement strategies out there, so many retirement concepts, and of course, so many retirement products, it can really become very difficult for consumers to digest it all. That is why we're so fortunate to work with a team of expert advisors to help us build a financial roadmap to let our clients know when, where, and how they can reach their retirement goals.
For additional concepts on how to maximize your retirement, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos. Carson, the stock market has really been pulling back this year. So how are you able to calm your clients down during this time we're in?
Yeah, Andrew, as you know, I've been a financial advisor for more than 20 years now. And, we have seen these type of marketplaces come and go. And, typically the narrative is the same. The narrative is always the same. It's inflation, or maybe there's a bubble. There's maybe a pandemic. The narrative is always the same, but the actors may be different, and it may be you in the next time when you're actually in your retirement years. But the one way that I help my clients, Andrea, is to make sure that we focus on their retirement plan. As long as your risk tolerance and your long-term financial goals have not changed, there is no reason to deviate from what we've actually scheduled for when it comes to the marketplace, because a good financial plan would actually account for these type of situations in the marketplace. So that's what we're going to be discussing today, a concept that may help alleviate some of the pain that people are seeing right now as they are still walking and building for their retirement, Andrea, and whether they should continue to dollar cost average into their portfolio or try to time the market and do lump sum investing. So that's what we're going to be discussing today. But before we get into that, there are 2 rules to retirement income that we like to give you. And Andrew, what are those 2 rules?
Well, rule number 1 is to never run out of money. And rule number 2 is to never forget rule number 1.
Okay, so let's go ahead and talk about the advantages of dollar cost averaging versus perhaps lump sum investing, or better yet, buying the dip.
So Carson, there's a lot of talk about worst case scenarios. So again, why should anyone want to be saving in this type of market?
Andrew, that's going to be a question that many people are going to be, trying to deal with when they're looking at, should I still continue to invest in a falling market? And when people are talking about worst case scenarios, I think most of us realize they're always leaning back towards the Great Depression, right? That was a period between 1929 to 1932 where the Dow Jones literally lost almost 90% of its value. So you can imagine the strain that would have put on anybody during a time frame like that, and how hard it would be to stick to any type of retirement plan when you're talking about a 90% loss in value. And of course, the marketplace did not recover until 34 years later in 1954. So this could be a difficult situation for anyone. I understand that. And of course, Andrea, if you are actually on a fixed income and you're actually pulling money out of your portfolio, well, dollar cost averaging is going to have a reverse effect on you, because you're going to be subjected to perhaps sequence of returns risk. You're pulling money out during a down market and the marketplace is dropping as well. So you have to account for that. Maybe you have some cash on hand. Maybe you tap into a reverse mortgage, or maybe you have annuities to help buffer out your income and of course prevent you from tapping into your equities as the marketplace is dropping. But nevertheless, it's always going to be difficult for people to try to stay focused when they are seeing their portfolio's values drop, and to continue to put money into a situation like that. So we are definitely going to cover why this may be an advantage to someone if they can get the right information and the right perspective on why this can actually work to their advantage in a down market.
So Carson, how can dollar cost averaging help people in a down market?
Yeah, I think it's important to understand first what dollar cost averaging is for those who may not even understand this terminology. When we're talking about dollar cost averaging, Andrew, we're just talking about putting away a consistent amount of money every single month without fail. You're putting $100 a month away into your portfolio without fail. When the market is up, you're going to get a little bit less for your buck. But when the market is down, you're going to get more for your buck. The market is, what we like to call in the industry is the market is on sale. So you're getting more bang for those dollars that you're putting away, but you're doing it consistently. So what I want to do here, Andrea, to really highlight the advantages of dollar cost averaging versus lump sum investing, or again, buying the dip. I want to take our attention to the screen as we're going to educate you on how this may play out. So here on the screen, we're going to look at two investors, Investor A and Investor B. They're both are going to be committed to putting away $400 in this scenario, in this hypothetical scenario. And so we're going to look at basically a 4-month time frame here of how dollar cost averaging could literally work it to someone's advantage in a down market. So Andrew, as we take a look at the chart here, we have a generic stock, ABC stock, and this stock is currently trading at $100 per share. Okay. Now, as you can see, Investor A is going to put in $100 per month consistently. And so with Investor A, they're going to literally buy one share. Okay. They're going to buy one share of ABC stock. Now, Investor B, they're not going to invest anything right now. They're going to sit on the sideline. They're going to wait to buy the dip. So now the next month, ABC stock, sure enough, dropped to $50 a share. And so Investor A is still consistent. They're going to buy $100, not anything more. And so in this situation, Andrew, because they're putting in $100, they're going to be able to get 2 shares now. It's $50. That $100 is going to buy 2 shares instead of 1. Here, Investor B sees a buying opportunity. They're going to buy the dip. They hop in. They take their $400 and they go ahead and buy in ABC stock at $50 a share, and therefore they're going to own 8 shares of that particular stock. Next month, ABC stock dropped to $25 a share. Investor A is still committed to their plan. They're still buying, and now instead of buying 2 shares at $50, they're able to get 4 shares at $25 a share. Investor B, on the sidelines, they're happy with the dip that they got, and they bought in at $50 a share, and they're very happy with it. The next month, in month number 4, you can see that ABC stock went back up to $50 a share. Investor A, still committed, is going to buy again another 2 shares. Investor B is no longer in the game. They spent their $400 in the second month, and they still own 8 shares. And so as you can see, now the total shares for investment A is 9 shares. The total shares for investment B is still 8 shares. The average price over those 4 months was $56 a share. That's what the average price for those stocks over those 4 months, from $100 a share, $50 a share, $25, and $50 a share. Now, as we can see, Investors A cost per share, Andrew, was only $44, even though the average share price was $56 over that period of time. That is a very good point to note when you're dollar cost averaging. A lot of times, depending on the situation of the market and the prices, you can end up owning more shares for a less cost. Because as we take our look at Investor B, their cost per share was $50. They never got back in. So that is a very notable point to make when you're thinking about dollar cost averaging and some of the advantages that you may see there. Now, the other part, the last part of the equation, is probably the most important, Andrew, the portfolio value. As you can see, Investor A owned 9 shares, and currently the price of those shares is at $50 for ABC. So their portfolio is valued at $450, whereas Investor B They own 8 shares, so they own less shares, and at $50, their portfolio value is still the $400. They haven't lost anything, they haven't gained anything, but investor A has actually increased their portfolio value by $50, and they own more shares. And so you can see the ramifications of dollar cost averaging, if the market is going down, can be highly beneficial for those who can consistently do so when the market inevitably turns back around and starts to increase. Andrew, I do want to make one last important notation about dollar cost averaging. When we talked about that worst case scenario in the Great Depression, if someone were to have been committed to just putting away $100 per month, Andrew, from 1929 to 1959, 30 years, their investment would have been only $36,000 over that period of time, but their portfolio value after 30 years would have been over $400,000, $411,000 to be exact. Now, as you can see, dollar cost averaging can absolutely reward you if you can remain disciplined enough to allow the effects of dollar cost averaging take place for you. Very difficult to time the market, Andrew. So I encourage those of you who are thinking about, the falling market and trying to buy the dips, do not do that. It will maybe to your benefit to just consistently put away dollars, because it can reward you on the back end.
Well, Carson, thank you again for your insight on this topic, and thank you for watching. And if you felt this information was beneficial for you, please like this video and share with others.
So I really do hope that the information that we shared with you in this video today will give you some better insight on the value of dollar cost averaging versus lump sum investing, or again, buying the dip. Please note that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for a fiduciary financial advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in our description below and go ahead and schedule a no obligation free 1-hour consultation with us today.
For more information about this topic or any of the other topics that we've shared in our other videos, please feel free to reach out to our office or leave any questions or comments in the section below. After this video, please check out our other videos that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers.